Price of Bitcoin surging again this morning, passing through the $73,000 level. Ethereum now up over 4,000. Joining us right now is Michael Novogratz, Galaxy CEO. Mike, let's talk about why it's ripping. It seems to me that this is simply a more of a supply-demand issue than it says anything about either even liquidity in the market or just about anything else, that this is actually idiosyncratic to this unique and particular moment. Am I wrong or right?
Well, listen, there's a mindset shift, right? That all of a sudden the U.S. has broadly endorsed Bitcoin, right? You think about what's going on in D.C., this is a vote, right? The American people have just voted, and they have voted they like Bitcoin and they like digital assets. And so Washington needs to get off the stick, get off the couch and start doing something, right? This is going to be an issue for Democrats in this election who have been perceived to be standing in the way of Bitcoin in races like Ohio and in Montana, the Senate races. You know, the crypto pack is putting in money. And so I think that's what you're seeing. You're seeing baby boomers get their first shot, right, through the RIA channel. Like there's $80 billion or $80 trillion of baby boomer wealth, and they're putting a small amount in. And Bitcoiners don't like to sell. Like they often think of their net worth and how many coins they have, not how many dollars they have.
That doesn't explain gold, Mike.
Well, listen, gold's going up as well. We have a political situation where both candidates seem to want to spend a whole lot of money. Right. You know, when Biden's deficit or Biden's, budget came out with a $1 trillion+ deficit, that doesn't engender a lot of spirit when it comes to wanting fiscal prudence, right? Bitcoin has always been a report card on fiscal stewardship. And we've got no stewardship in D.C. right now.
And we're cutting. We're cutting eventually. Don't you think Bitcoin is expecting the Fed to, when it pivoted, did Bitcoin go down because of the hiking cycle we were in? Now it's going back up along with the...
Listen, there's two vectors of Bitcoin. One is adoption, and this move is mostly adoption, and the other is macro. And the macro factors are, right, the Fed, but it's also, and it's mostly Congress and the budget, right? We are running deficits that are in crises levels.
Right.
And when you look at our fiscal situation,
I think we're going to both agree it's the adoption issue right this very moment.
100%.
It's more about adoption than it is about anything else, and it's adoption via the ETF, and therefore we have like a supply and demand problem.
And
right?
having.
Maybe,
prices are set on the margin. Right?
You can throw in the having. Let me ask you this. Ethereum right now has moved in a big way. Part of that is on the back now of speculation or of an expectation somehow that we're going to have a Ethereum ETF and that is going to create a similar kind of dynamic. Do you think that that's the right way to think about it? And do you actually think that there will be an Ethereum ETF?
Listen, I think there's a fierce debate inside the SEC right now, right? I mean, Gary Gensler, before he was at the SEC, is on tape saying Ethereum is definitely not a security. Since he's been at the SEC, he hasn't made a ruling on it. And I think what the SEC is doing is debating, can they call Ethereum a security with this idea that it changed when it went from proof of work, right, for validation to proof of stake. If they can't make that argument, and I think it's a tough argument to make, they have to, they're going to approve the ETF because it's the same argument that won the Bitcoin ETF. There already is a futures Ethereum ETF. And so if you have it for futures, you have to have it for cash. That's what the court said last time.
Mike, who takes that case to court? Is that a Coinbase case? I don't even know. It's funny. Grayscale, which is effectively put this into business as an ETF, I don't know if that's actually been good or bad for Grayscale long term.
Yeah. Listen, I think if you're Barry Silbert and you own a whole lot of Bitcoin, a whole lot of shares in your own ETF, and the price goes up, 100%, you're pretty happy. And so, right, that court case crunched the discount from -40 to 0, and it drove Bitcoin prices up. And so the Grayscale holders are thrilled with that lawsuit. And I think the same would be true in Ethereum.
Mike, are you out of the business of telling us what? I wouldn't even try at this point. Remember, in the past, we've always asked you, all right, it's at 40. Is it going to 35? All right, it's at 35. Is it going to 30? All right, it's now at 30. Is it going to 20? So we went from 20,000 to 2, 63,000. We went from 65,000 to 17,000. We're now at 73,000. Are we past where, because of this adoption you talked about, are we past the point of it going back down to 20,000 and then back up, do you think?
Listen, I think so, but this has been a wild ride of an asset. We're in price discovery mode right now. And if you're looking at the charts, you could see 100,000, like that could be a target, but you don't know when you're in price discovery mode because we had $1 billion of inflows last night into the ETF complex. As long as that is positive, the price is going to keep grinding higher. Once that becomes negative, you'll see the first real correction. And so I think right now every trader is watching, add up the 9 ETFs and see what the net is. And as long as there's inflows. Now, of course, there's lots of other inflows and outflows in the Bitcoin universe. But right now, that's got the zeitgeist of what people are making their trading decisions off of. Things are frothy. Funding rates are high. And so in times like this, you always have to be ready for a correction. I don't think we go back below 50, 55,000. I think that's the new floor unless something dramatic happens.
See, I thought you were out of that business. I don't know if I.
Hey, Mike, one of the things that's so interesting is most of the inflows seem to be coming in via the ETF. It's an interesting way to play this, if you will. But if everybody ultimately is buying in via the ETF, and if that becomes sort of the majority approach to touching this quote-unquote asset, there's a question about what the asset is doing, right?
Well, listen, market cap at 74,000 is what, $1.5 trillion. And I think ETF is 40 billion. And so it's still a very small percentage of Bitcoin's price. The genius of Bitcoin really is that Satoshi white paper, which sets the monetary policy for this ecosystem in code. And in a world where, look at the Nigerian currency, pull it up on your chart. And so if you're in Nigeria, it's interesting in almost now in every country on earth, Bitcoin has made an all-time high, but in some of the charts, it's staggering how much wealth it preserved. And until you get countries that run more credible fiscal policy, people are going to want to buy that story. And it's a story that's spreading.
We are sort of wondering whether, if there is a breakdown in quality or momentum, both, the chips could be the most vulnerable. And maybe you're seeing some signs of that this week. Week-to-date losses in the semis. Marvell's down 9%, AMD's down 5.5%, and this is outside NVIDIA, obviously. Micron's down 4%, Broadcom's down 3.5%. Broadcom, quality momentum, that's been on the list. Christina Partsenevelos is here at Post 9 to help us look at this. Is that how you're thinking about this? Like, if you do have a bigger breakdown, your beat, your space is going to be the place to look, perhaps?
Oh, 100%. And I have so many comments to what you guys have said. But let's start with Broadcom and Marvell. Their earnings were last week. Why we're seeing this, weakness compared to other chip names is because, yes, they have AI momentum with their custom chips, but they're still exposed to the rest of the cyclical chip market. And specifically with Marvell, they guided weaker for this April quarter. So that, dragged on the stock. For Broadcom, they reinstated their full year target. Many were expecting that to go higher. They didn't. Yeah, there was some hype about the custom chips, but that you still need to keep that in mind when you talk about the momentum argument, when many of these chip companies, AMD, for example, are exposed to other facets of the market. And I question the timeline, which was what you both brought up. With NVIDIA, yes, they're launching their H200, their new B100, which is a completely new architecture for the GPU. They're talking about inferencing, which is 40% of their data center revenue, so that's going to help drive growth. But then you see a report from The Information just yesterday talking about Google, Microsoft, and Amazon warning that customers are cautious on their AI spending because they need to see that return. So I wonder in 6 months from now, if that return is not there, then those CapEx budgets get cut, and then that creates a different kind of momentum trade, or maybe less of a momentum.
Well, I think it creates at that point a reversal of the momentum for sure, and you're underscoring the element of why you've had this positive catalyst for all these semiconductors, because Microsoft, Alphabet, Amazon, they're sitting there, they're spending billions of dollars to build out the infrastructure, and they need these semiconductors to do it. And I'll go a little bit further. They need companies like Cadence and Synopsys as well.
But do they need that 2 years, 3 years from now? Constantly spending that amount?
That's a great question. And candidly, Christina, I don't know that anyone really knows the answer to that. What's the length of this cycle? I think is the big question right now. And I think for people to come on the network and say, oh, I think it's going to be 6 months. I think it's going to be 3 years. I think they're just guessing.
But it's a possible risk.
The stocks are not trading like,
no, you're right about it.
We've given the benefit of the doubt, so to speak, to almost everything.
Yeah. The stocks are trading as if demand is sustainable forever. And if you just look at the charts, even from price to sales, bless you, for NVIDIA, you really see this just uptick. And so you question, there's comparisons with Cisco back in the 90s. Can it keep up this trend? Well, if those big guys don't come through, yes, NVIDIA will say, well, every other facet of the market, healthcare, auto, finance, they're all buying. But they're smaller players. They're not going to be spending, buying 200,000 GPUs, like, let's say.
Look at NXP. Isn't NXP's on the list?
NXPR is one of our holdings as well.
That's been one of those stocks that's been trading near a high. Jim Lebenthal just taking a little bit off the table the other day because it's like my chip exposure has gotten too big. It's making me a little nervous because the space has gone crazy.
Absolutely. And, I look at the performance of the semiconductors. We have 11% exposure, and I question, again, how long can this continue? My personal perspective is there's actually election risk surrounding the semiconductors. And I think there's big election risks surrounding the semiconductors. So that's probably one of my primary concerns from a fundamental aspect.
Well, there's not much concern on Wall Street because Broadcom reiterated a buy at city price target $1,560, $1,560 for Broadcom. So, there continues to be all this bullish sentiment around these names. No one is, really willing to give up the ship on these yet.
No, and I think the challenge is that this is the first wave of AI, and people understand that if we go back to the .com bubble, the impact, the longer-term impact that we're still seeing through cloud optimization, for instance, of the internet itself, that is the likelihood that this trend could persist decades from now in terms of what it can do for the larger economy. The easiest way, the easy button for AI right now is chips. And so I think now you really have to take a step back and say, from a fundamental perspective, to Christina's point, what companies are spending on AI that are actually going to be able to monetize that AI? You're going to have to show results a lot sooner than 2025. This is going to be a 2024 story for some of these companies, and I think that's where you could see money come off the table, not necessarily because the AI trend is not sustainable or defensible, but because there's better ways to catch this second wave.
NVIDIA is going to remind us early next week exactly what their dominant role is, correct?
Yeah, I'm going to be there. So it's in San Jose, and it's their big AI event, GTC.
Monday, Tuesday.
This is the first live event in 5 years, and there's so much hype around it that they had to rent out the SAP stadium. So there's way more people expected. Every hotel is booked. We're expecting comments on, of course, their new chips this year, collaborations with partnerships, how they're going to monetize software. That's a big one for them, right? Because it's the whole ecosystem, and that's going to be the reoccurring revenue. And then inferencing, which was a little bit of a surprise, the second stage of a large language model, that is driving 40% of their data center revenue. But inferencing is at a lower price point, and then you think of their new AI chips, the B100, that's expected to be 30% higher than their H100. So, margins may be improved, but demand may drop. There may be demand shifting towards the custom chips from Amazon, Microsoft, et cetera. So there's a lot of factors at play. But normally, according to UBS, the stock tends to go anywhere between 5 to 6% higher post these events on Monday. This is on a 6-year average.
Yes.
So there's alternatives to NVIDIA as an investment manager, but is there true competition when you think about it? It's NVIDIA and then everyone else.
Right. In the training process, no. I would say at the moment, no. But then in the inferencing stage, I do believe that there could be a lot more. And this is where maybe the technical side is not, the nerds in the chip world will say otherwise. But you have such specific tasks, and you can save a lot of money when you don't go for that giant expensive chip. So maybe I think that's where they'll lose a lot of the market share going forward. Right, but for now, first mover advantage. Right?
We'll look forward to seeing you out there Monday, Tuesday. Christina Partsinevelos, thanks for being here.
Anytime. Dan Ives, Wedbush security analyst, joins us this morning, has a new note looking at the impact of a TikTok ban, something we've been trying to work our way through as we kept our eyes on the Hill. Dan, well, I won't ask you to give the calculus on passage in the Senate, but let's pretend this goes through. What happens?
Look, it's a game of high-stakes poker. Because, first of all, there's a retaliatory in terms of China. What do they do with Apple, Tesla, in terms of that? Is this eventually acquired by big tech? What could the valuation be? Call it $100 billion plus. But then we believe 25% chance that this ultimately passes, just given the regulatory spiderweb that we see. Clearly, Meta benefits and others. But look, we believe this is a slippery slope. It's a watershed moment. You are playing a little with fire going down this route. And we think this is, within the Beltway, it is you can't put the genie back in the bottle. And I think now we need to see how this all plays out over the coming weeks in this sort of 202 drama.
So would you be re-rating Meta, Snap higher or lower?
So we still believe here, based on all of our work in the Beltway and our advisors, 25% chance this ultimately passes. But with that said, it's incrementally positive for Meta, for Snap, for others. But I think we need to see how this all plays out over the coming weeks. But no doubt, if I go back a month ago, the fact that we're actually here and the House passes it, given the pressure that we've seen, it's a surprise. And I think it's a surprise in Beijing. Look, I just got back from China, and in terms of overall Asia, and you see a lot of tensions that's rising. This is not what we want to see in Beijing.
So what does this mean for the potential retaliatory measures that China could place here? If it's at least a near-term positive for a Meta or a Snap, but then China retaliates against U.S. tech, then what could that look like?
Well, and for Cook, for Musk, that's the issue here. Right. And as we've talked about a lot, right now it's not roses and rainbows for Apple and for Tesla in China. The retaliatory is what you worry about here. Not for Meta and others, but specifically for Apple and for Tesla. And that's why we say you're playing with fire. And this game of high-stakes poker, it's great for grandstanding here, but not just from a First Amendment perspective, it could have massive implications from a retaliatory in what's already in terms of that U.S.-China cold tech war.
Yeah, I mean, I brought this up yesterday. How would we react if China decided, oh, Tesla, you've got to divest your operations in China to BYD? We would not react well to that. That said, it's very much unclear, Dan, I should just point out from my own reporting, that there's any chance the Chinese would allow ByteDance to sell TikTok to another company, including the source code and the algorithm. That's not going to happen. And so it's very hard to figure out what will happen here. Before we let you go, though, I wanted to actually come back to Tesla and just have you respond to this Wells Fargo note today, questioning, obviously, significant discounts, profit per car coming way down, and their price target at Wells now, I think, 125.
Yeah, we strongly disagree with him. Obviously, we respect the analysts and the call, but I think right now overly negatively discounted in terms of the Tesla story. Look, near term, clearly units are going to be soft for 1Q. Just getting back from the region, I believe price cuts are now starting to subside in China. That's important. I think when you look through the next 6-9 months, we're going to look at this as more of a golden buying opportunity for Tesla over the next 2-3 years, especially with AI, rather than time to throw in the white towel. But for now, we all know, I mean, the New York City cab driver is bearish on Tesla here.
What does that mean? Sorry.
Everyone's bearish. The piling on's there. The bears are coming out of hibernation mode. I get it.
I see what you mean, yeah.
But we believe now is not time throwing the towel on Tesla and Apple. I think we see there 6-9 months now, stock's much higher.
As you see the makeup of this market change a bit, right? NVIDIA cool down and some of these other areas pick up. What are you thinking?
I'm thinking this is a healthy development, quite honestly. We've seen a lot of focus on the outperformance of the Magnificent Seven. And as we know, some of the Magnificent Seven haven't been so magnificent recently. And if some money comes out of the Magnificent Seven and spread more evenly across the rest of the market, that would be a healthy thing. For example, the S&P equal weighted index has recently gone to a new high, which is a good thing. So I think that a broadening of the market is probably what's in store. And I think we're also likely to see less momentum. I just looked at the latest Investors Intelligence bull-bear ratio, and it's off the charts. It's not completely off the charts, but it's up to 4.2. It can go higher. It has gone higher in the past, but this is up from 0.56 right at the bottom of the of the bull market, right when the bull market just started. The sentiment was horrible. Now everybody's bullish, and that means there may not be enough bears around to convert into bulls to keep the momentum going. So I think we're going to see some weakness in the momentum trade and more of a spreading of the market to other sectors and industries.
It's interesting you say that. I was going to ask you whether you feel like you still have to prove to people that this is, in fact, a bull market that's not close to being finished yet.
Well, I think we're way past the point where I have to prove that this is a bull market. I think we all know it's a bull market, but look, bull markets can last a long time until we get hit by another recession, and that requires the Fed to be raising interest rates. I didn't anticipate a recession over the past couple of years. We just went through an environment where we had the most widely anticipated recession of all time, so it turned out to be a complete cadeau, complete no-show. And I don't see a recession this year or next year. I mean, the Fed has already raised interest rates. I think inflation has come down. I think it's going to stay down. You know, excluding shelter, the CPI inflation rate is already at 2%. You know, when you have kids and you go for a drive and they say, "Are we there yet?" Well, we're there, except for shelter, and shelter's coming down. Shelter inflation's coming down. So I think it's a long-term bull market. I got still 5,400 by year end. That was a pretty bold call of like a year ago, but
it was.
Right now it's looking pretty conservative.
Yeah.
And why not more? I mean, people ask me, why aren't you raising your numbers? And so, well, you know, there are kind of limitations in terms of what earnings can do and how much higher valuation can go. But I see 6,000 next year on the S&P 500 and 6,500 after that.
And do you dismiss the inversion of the yield curve because the Fed's going to be cutting rates and thus you'll have a re-steepening? How do you view that?
I wrote a short little study that's on Amazon. I'm not promoting it because I'm going to make any money on it, but because in 2019, Melissa Tagg and I, my colleague, we wrote a piece on the yield curve and what does it really mean? And this notion that an inverted yield curve means that we're going to have a recession, I think misses an important point. What it really does is it predicts a process. It predicts a process that if the Fed continues to raise interest rates, something will break in the system, and that will lead to a credit crunch. And it's credit crunches that cause recessions. Well, the yield curve got it absolutely right again. And we did have a financial crisis last year, but the Fed came in and played whack-a-mole. That liquidity crisis, they whacked it right down with the liquidity facility, and we didn't get a credit crunch, so we didn't get a recession. So as long as we don't get a credit crunch and not a recession, I think the bull market continues.
I mean, you've never had a recession without an inverted yield curve, but an inverted yield curve alone doesn't mean you're always going to have a recession. I think that's the fair way to say it, but it's been inverted for so long that, you know, people are still at the stage of, well, I got to keep my eye on that because the yield curve has always meant something, and the bond market has been right many times, as you obviously know.
Yeah, well, I've been fighting the inverted yield curve story. I've been fighting the leading indicator story. I think the leading indicators really are an indicator of what's going on in the goods economy, much more so than in the services. And the inverted yield curve, again, I think it got it right in terms of calling a financial crisis. But the Fed this time around did something different, which it hadn't really done before, and that is it came in with liquidity to keep the financial crisis from turning into a credit crunch. I really should correct myself. I mean, the Fed got a lot of experience dealing with these credit crunches and avoiding them back in 2008, 2009, and again in the pandemic. So they're pretty good now at playing whack-a-mole with liquidity crises.
Tesla's getting hit with a big downgrade to underweight from equal weight over at Wells Fargo, citing numerous headwinds ahead. The firm expects volume to disappoint and also lowered its price target from $200 a share to $125. Here's the analyst who made that call, Colin Langan. Phil also on the line with us. Colin, welcome. Good to see you. I'm curious, what is the market share of Tesla in the U.S. Among total automobile sales, auto and truck sales, and among EV sales? What kind of share do they have?
I mean, they're very small into the overall market. I mean, they're very large in EVs. I mean, what we're seeing, and that was the point of our report today, is that we're actually looking at the impact of the price cuts are surprisingly low at this point. We saw volume actually, if you look at first half to second half globally, up just 3%, and pricing was down 5%. And that's really what driving our lower deliveries. We're expecting deliveries to be about flat this year. Because we're really expecting more limited ability to cut price. Otherwise, you're going to hit a point where you're not very profitable anymore.
So you cut price, you hope volume will increase, but you're not seeing the kind of volume increase that is commensurate with the price cuts. What about this Model 2 that they expect to bring out in 2025? Is it going to be a game changer, or is it too little too late here?
Well, I mean, I think that was the other part of our report today. We were looking at the potential for Model 2. I mean, and one of the things that really is concerning to me is that it's different from other launches. This is a mass market priced SUV. That's going to be very tough to do. I mean, the actual, if you go to an internal combustion engine, compact vehicle today, they're not very profitable. You add on an e-powertrain, you're probably starting off at a losing point. And then if you're then really betting on this unboxed production, which is the new manufacturing methodology they plan on launching with the Model 2. That's a bit of a wild card. It's just never been done before, and we still estimate you need most of those benefits to come through to get this to profit levels that we're seeing on their current vehicles.
What does unboxed production mean? I noted it in your note, and I wasn't sure what it meant.
Yeah, I mean, it is a new term. No one has actually done it before. So the idea is it's a change in the entire assembly line. And from experts that we talk to, they're trying to eliminate all the bottlenecks, automate as much as possible. The vehicle won't run through one line. It'll actually be assembled in different subcomponents and then come together at the end. This enables, one of the potential benefits maybe is you could put more throughput through the paint shop, which is the bottleneck today. But also you probably could automate more along the line and eliminate some of the manual inputs. So it's supposed to improve your efficiency. What we found in our report is that, there's probably between labor and fixed costs that are absorbed per the vehicle, it's probably $9,000 to $10,000 per car. So if you could double that, there's like $4,000 to $5,000 in benefit. You really kind of need most of that benefit to get Model 2 to probably profitability given the powertrain costs you'll be adding.
Phil?
Hey, Colin, it's Phil LeBeau here. I'm curious, when you look at all of the headwinds, not just for Tesla, but for electric vehicles overall, what do you believe is the biggest one right now? Is it the fact that we're not seeing enough models at the lower price points that would drive sales? Is it the concerns about range adoption or range anxiety, charger anxiety that is out there? What do you think is the number one headwind?
I mean, I think number one has been pricing. I think it's, and I think it's just the price. I also think we need sort of SUVs too, so I'm not sure a small vehicle actually necessarily addresses that for what Americans want. So I think one, people want more affordable EVs, and then two, it's always been charging. But the one thing we talk about in the industry, and one reason we're cautious on all of the Detroit 3 as well, so we're pretty cautious on the automakers right now, is the fact that there's still regulations coming. So the industry is going to be a really tough spot here because the automakers are going to need to sell more EVs to hit those standards, which means everyone's going to be forcing these vehicles into the market, which is never very good for profitability when that happens.